want to give you a nice warm welcome to all of you who are joining me live for our Short Verticals webcast. I'm Connie Hill. Been teaching this strategy for many, many years. I'm going to say 20 plus years. And I think you're going to find it as a strategy that maybe could help you in your portfolio. How would you like to master a strategy that if the stock doesn't do exactly what you were hoping it would do or thinking it would do, that you can still have a profitable trade? Yeah, that's what we're talking about with Short Verticals here today. Now, I am joined in the chat by good friend and fellow coach, Brent Moores. Brent is here to help me answer your questions. All right, I'm going to keep an eye on the chat. Go ahead, type your questions in there. And as needed, Brent will help me out with a little bit of backup with some of your questions. Now, I hope you're following me on X. Those of you that are new may not be following me on X yet, but my handle is @ConnieHillCS. Brent does a lot of great posting as well. He is Brent Moores CS. If we see something interesting, we think that you might find it interesting too, we'll put a little post out. And of course, it's free to do, easy for you to join us. So we would love to have you follow along. Let's go through our disclosures and I'll lay out the agenda that we have for today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for educational and informational purposes only. Don't consider it an endorsement of any type. We will be using the Paper Money software application. This is what you download to your computer. It's fabulous for educational purposes and getting the knack of how the Thinkorswim platform works, as well as testing out new strategies. Investing involves risk, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. An in-the-money option has a higher risk of being assigned early. And one thing you need to know is that Paper Money does not assign early. So we like to make you aware of that difference because the live market can and has done in the past assigned people early. Past performance of any security or strategy does not guarantee future results or success. Now, I want to kind of let you in on a little, it's not really a secret because it's public information, but we do some workshops in local areas that you can come and join in person for free. We are so nice to you. We teach you, we feed you, give you the opportunity to mingle with some of our coaches and workshop instructors. So these are the next 3 events coming up. They all start with the D. We've got Detroit, Dallas, and Denver, okay? I will note the Dallas is an advanced option strategy. So those of you that maybe are a little bit more advanced in your skills, we don't have as many of those workshops. So you might want to, key in on Dallas. And I'll tell you, if you haven't been to one and you go, you'll go, oh, Connie, I'm so glad that you pointed that out to me. And you'll just have a great time and learn so much. All right. Today we have a lot of folks joining us. Some of you might be newer to this class and maybe newer to this strategy. So we're going to just give you a quick introduction to Short Verticals, even though typically it's a little bit more of an intermediate class that we teach here. We'll talk about trade management, how that works, some ideas that you can have. We'll be going back and looking at some of the example trades that we have in our class that we've done in the past. And of course, we're going to do some new example trades here together. So for those of you that maybe are not familiar with short strategies, short spread strategies, the one we're going to focus on today is called a short call vertical, which is a bearish strategy. You may have noticed market has been a little bit more bearish lately. And so it's nice to be able to have the particular strategy that you are interested in doing align with what the overall market is doing and with what the particular stocks are doing. Okay, so in this case, we're really going to focus on the bearish side. And what we're going to do is we're going to be using 2 different strike prices. The primary one is the one that we're going to sell. It's the one that has the most premium associated with it. And then to act as a hedge and to help confine our risk, we buy another option that's a little bit further out of the money, has a little bit lower price value. Together, they create a short call vertical and they create a premium that comes into your account as a credit. Now, many trades that you might get into, in order to get out of the trade, something has to happen, right? You buy the stock and then maybe at some point later you sell the stock in order to get the profit there. In this strategy, you get paid the premium up front, right at the beginning of the trade, instead of waiting to the end of the trade. Okay, so that is one thing that people really like about this strategy, is being able to get money right up front when they place their trade. Now, what kind of stocks might be good candidates for this strategy? Well, we're going to look for stocks that are either in a bearish or a neutral trend. We want to find stocks that are having higher trading volume because we want them to have a lot of active option contracts. When we see a lot of contracts, it means that it's easier to get in and out of. It also means that generally, not always, there will be what we call a tight bid-ask spread, which means the difference between the bid and the ask prices is really small. So the stock doesn't have to move a great distance before you cover that spread, right? That's one of the other things that's appealing here. And then let's talk about the when. When would you instigate this kind of strategy? Well, if the stock is giving us some entry signals that people like to use for bearish entries. So for example, if a stock is breaking below a support level, that can be a bearish entry. If the stock is maybe run up and maybe hits some resistance or hits into a moving average and rolls over, some people like to use that as an entry. And then something that we call affectionately the Kablod signal, which I have the acronym for you right here. It's a close below the low of the high day. And so as we see a stock rally up, hit a high and start to pull back, and we see that price of the stock is going to close lower than whatever the low was on that high day. Some people like to use that as an entry. And we're going to be looking at examples of several of these. All right, so let's go to work and let's put together our first short call vertical that we're going to work with today. I'm going to head over to my Thinkorswim. I've got the SPX up here just so that we get an idea. Yeah, the SPX overall had been in a nice uptrend, but right now showing some weakness. Now I have two moving averages on my screen. This blue one is a 10-day moving average. The red one is a 30-day moving average. So the blue line gives us an idea, what is the short-term trend that's going on here? The 30-day is kind of an intermediate moving average. What's the intermediate moving average doing right now? Sometimes people, instead of a 30, sometimes they may use a 40 or 50, which is just fine. For our purposes today, we're just going to use the 10 and the 30. So we can see, gee, that blue moving average, yep, it's headed down. That's letting us know the short-term SPX trend is bearish. And then the intermediate trend has started to roll down here as well. So that's why we've got our bearish hat on and are looking to do bearish trades. Now, the first stock that we're going to take a look at here as our first example is going to be ticker symbol VST, Vistra. This is actually a utility stock. And a few months ago, some of the utility stocks were having a really nice run because they were starting to use AI in terms of regulating their operations. That was generating some efficiencies for them. And so some of them started to really trend up quite a bit. But this stock, like many others, is running into some difficulty right now. So we can see its 10 days on the downswing, its 30 days on the downswing. And I'm going to move, just kind of drill in here a little bit closer because this also has a price pattern. And some people may use a breakout of a price pattern as an entry point. So the price pattern that I'm seeing here is what we call a bear flag. Now this one has a couple in a row. I'm going to start pointing out the first one we might see here, which starts about right there. It's a quick drop, kind of a pop, 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 or if it's a bullish one, pop, pop, pop upwards, but just kind of a real quick motion down. And then it had a little bit of what we call consolidating. All right, sometimes that consolidation goes counter to the direction of the flagpole. And then when the stock breaks out, which happened here on this red candle day, that would be an entry into the bear flag pattern. Now, what we're seeing right now is a different bear flag. And I'm going to draw this bear flag starting at the high of that red candle. And then I'm going to come down to maybe about three candles down. And then we saw what? We saw the stock start to consolidate This time it was in a sideways pattern. We might call that a flag that's in a stiff breeze because the flag pattern's going sideways rather than sloping upwards. Okay, what do we have today? We have a breakout of another bearish flag. And so it can be used as an entry point. Now, some of you might also say, well, it also meets the definition of a close below the low of the high day, which it very well may be in our pullback, our pull down, and then our run up or our consolidation. We look for where was the high day and look for the price of the stock to close lower than that. And so far, it looks like it may close there. We're not at the end of the day yet, but we're a good distance into the day that it seems reasonable that it probably could be meeting that signal as well. Now, let's go ahead and construct a trade based on, hey, this has a bearish entry signal here. So as we come over here to the trade tab, I'm going to point out a few things to you about this stock. We looked at its pattern to see if it had a bearish entry or a neutral entry. We also are going to see this stock has quite a bit of trading activity on it here today. 6.5 million shares have traded so far. That's a good, healthy number of shares, which typically leads us into stocks that are a little bit more liquid. How do we know that it's liquid? We're going to look at this open interest column. We could also, if we wanted to, look at the volume column. Volume just represents today's activity. Open interest represents what is the balance of the contracts outstanding right now, okay? And every morning the volume starts again at 0 and we get an update on the open interest based on what's happened. So we love to see big numbers like what we're seeing here in the hundreds or in the thousands. Lets us know, yeah, there's a lot of trading activity with this particular series of options. Now, I want to show you also that this particular stock has some choices, all right? Choices as far as different contract series that we might be interested in. Back in the golden days, or maybe just the olden days, when Brent and I first started trading, we only had monthly expiration contracts. So these are the ones that have a white font, okay? All of these down here. And that was the only expiration dates we had. But as trading options became more prevalent, and the demand for shorter time frames became apparent, some stocks started offering weekly options. And Vistra is one of those stocks we can see with the yellow font there. Yeah, they have some additional ones. Now, sometimes there's a lot of activity in those weeklies, and sometimes there isn't. To save us time, I went through and looked at the weeklies to see if there was a lot of activity there, and there really wasn't in the weeklies. So we're going to use the monthlies on this today. And time frame, how much time do people typically want to sell that premium for? You know, many folks like to use between 20 to 40 days. Maybe sometimes it goes out a little bit more than 40 days, maybe up to 50 days. But the idea that they want to sell something that will decay, that we can capture that theta decay in a time that's kind of maybe not out too far, meaning many people might not even be interested in selling something out in May or June or July because it takes a long time for that premium that we sell to decay. So we're trying to find a balance of something that will expire in a fairly short period of time, as well as give us a premium that we're comfortable with, that we think, okay, this meets my criteria. So we're going to use the April 17 options that have 24 or 42 days before they expire. Okay, that's what that number in parentheses is. And then we're going to use, as far as a strike price, we want to have some guidance here about what strike price should we start out with? What is that main leg going to be? So we're going to be doing short call verticals. So we're going to consult this delta column right here. And many traders will look to sell either a high 20-something delta or a 30-something delta, or sometimes maybe even a lower 40-something delta, depending on what they're seeing out there and depending on how liquid the options are and the strike prices that are available. Now, in our case today, We have something that's a 25 delta, a 30, a 36, a 42, and a 49. So people might say, well, maybe the ones in the middle, okay, the 42, 36, and 30 might be decent candidates. For our purposes today, we're going to use this 130 strike price, and it has a 36 delta. Now, somebody's wondering if I can have this, make the font a little bit bigger here. You might want to take this full stream, and in your window, you have some controls. And when you see something that kind of looks like, I'm going to call it crossroads, like an intersection where you have like a four-way stop, click on that button. It'll expand your view. Okay, so it'll take up your whole screen as opposed to being a little bit smaller. Okay, that'll help quite a bit. Okay, with that aspect. Okay, so give that a try. Now, what we're going to put together here, we are looking to sell first our strike price that has the 36 delta, which means we would like the stock to stay below that strike price. Okay, it is at 130. Well, the price of the stock right now is at 115, so it's got quite a bit of leeway there. It's got about $15 between where the price of the stock is. So what we will put together here is I'm just going to do a right mouse click on the strike price we want to sell. We're going to say sell and vertical. And it's going to just grab the next strike price in sequence. And sometimes you want to use that strike price and sometimes you don't. In our case, we do. We like, that's just the next one in sequence, the 135. So we sell this one for about 585 credit. We buy the next leg down for about 480, and it creates this $1.25 credit for the spread. Now, one other thing I want to point out to you in our option chain is this column here that's called probability, and you can't see the whole title there, but it says probability OTM, which means what's the probability of this option expiring out of the money, okay? Our option that we've selected here is about 72, almost 73%. That means success in the trade. We have a 72% chance that this option will expire out of the money. And if we were to go over to the chart, because some people will look at the probabilities, they'll also consult the technicals. I know some people that don't use technicals. I'm a big technical person, so I love combining them. Okay, the probabilities with what we're seeing on the chart. So again, 130 is where we'd like to see the stock stay below. And at 130, where is that going to be? I'm just going to kind of put my mouse in that area. Pretty close to about right here. That's 130 and 41. So we just need the stock to stay lower than that. And for success in the trade, the stock can continue to drop like it's looking like it possibly could for a bearish trade. It could just go sideways, just kind of rinky-dink around, not really do a whole bunch, but stay below 130. And it can even go in an opposite direction. It could even creep up here a little bit. Maybe it even touches 130, goes in that range. But as long as it stays below there or gets back below there, there's still a possibility, a good possibility, that the trade could work out in our favor. And so that's one of the really big virtues of short verticals is you don't have to be perfect. You don't have to be perfect in order to be profitable with this kind of a trade. So let's go ahead. Let's come over here to the trade tab. Back here now that we have our technical look, our probability look. One thing I should mention to you is that I've created my own column structure here, and you can do that as well. Right here, we see delta, open, first part of open interest. We select in that area to choose our columns. And simply what I did is I said customize column set. And I selected here the ones that I wanted to see. If you have a column set that you like, you can go ahead and save it. You can give it a name. I'm going to kind of drag this over. This is the name that it gives it by default, which basically just lists what the columns are. You can leave it that way, which I have a tendency to do, so I know exactly what's in there. Or you could rename it to something else. Okay, you could name it Betty's favorite or whatever it is. Okay, as long as you know what it represents, and then you can go back and use it all the time. Switch back and forth between your columns. But this gives me a lot of the data that I need for this specific trade. Now, one thing I want to mention to you is the tight spread. Okay, we had lots of interest or have lots of volume activity today on the stock, which generally leads us to activity in the options. And then the spread between these two, 555 and 590, looks like what? It's about 35 cents. And so 35 cents is I'm going to say a decent enough spread that we would consider it tight. If you calculate what that difference is and divide it by the asking price here, it'll give us a percentage, which I'll just do one here real quick. We'll take our 35 cents and divide that by 585. And that says, okay, the spread percent is about 5.9%. Well, that is lovely. I would love to see that all the time. 5% is great, but if you get 3% or 2%, even better. And there are some people that might draw the line. They might say, if it's 10% or more, maybe not. Now, Bob has a question here. In this stock, if it went down today, 12 of those 15 points, sounds like we lost the sound there for a moment. My producer's letting me know that. So I'm just going to repeat what we just talked about, okay? And that was deciding if we had a fair spread or a spread that's acceptable to us, okay? So the difference in our strike price here is about 35. Well, it's changed a little bit. Now it's 20 cents. That's even better, okay? I'll use 20 cents. And if we take our 20 cents and divide that by the ask price, I think was 580, we'll go 585, then it's about 3.4%. When it was the first calculation I did, it was about a 35-cent spread, and that was more about 5%. So typically anything under 10 is something people are comfortable with, but the lower the better. Okay, if it's 3%, 2%, fantastic. Now, Bob asked a question here, and he said, in this stock, if it went down today, 12 of those 15 points, which is out of the money, what is the best way to protect against a bounce? One would be to lock in your profits, which we'll talk about here. Sometimes if you get a big chunk of this $1.25, you get it soon. Maybe you get it the first 3 days, 4 days. Or as Bob says, maybe it bounces down today and it gets into an area you're like, sweet, if I can pick up 50% of the $1.25 now and not wait till option's expiration, you might decide to do that. Okay? You'll have to work at a point where you say, this percentage of a gain is acceptable to me. I don't have to milk every single penny out of it. I mean, I do that with toothpaste. Man, I'll squeeze the daylights out of that container because I want all my toothpaste. But it's not always the best approach with short verticals, okay? Best approach with short verticals is if we can get a big chunk of it, if we get most of the toothpaste out of the tube, we're happy campers. We would be glad to lock in our profits and walk away. Now, in our class, typically we'll allow ourselves to risk $1,500 in a trade. Now, we don't have to risk that much. If a market's really volatile, you might not feel comfortable risking that much. You may want to back off of how much you're willing to risk in a trade. So today we're going to back off a little bit. We're going to go with a $1,000 threshold. And how do we determine what the risk is? We take the difference in the strike price minus our credit. Our credit is our max potential gain in this trade. We're not likely to make any more, leaving it as a spread. And we would be risking $3.75 to do so. $5 minus $1.75. Now you might be going, well, Connie, you're risking more there than what we have to gain in $1.25, and you're absolutely right. We are. Why would somebody be interested in doing that? And the reason somebody would be interested in doing that is because of the high probability of the trade being successful, right here about 72%, 73% right now getting into the trade. And typically people say, well, if it's 60 or higher, they'll consider that a high probability trade. Okay, so we are going to take the approach that we could potentially lose $3.75 per trade, per contract. So we're just going to do 2 contracts today. Take our threshold of risk down a little bit because of what's going on with volatility. And we're going to say, put in an exit order in case we get a good chunk of this. All right. So I'm going to change this to a first trigger sequential. I'm going to create an opposite order to execute for us if we get, let's go for 75% of this. Okay. If I have $1.25 and we've got 75%, then what's left? 25%. So I'm going to multiply that by 0.25 because that's the quickest way to get there. It says, okay, go buy it back at 31 cents. So we're going to put it in here and say 0.31. We'll be happy campers. We got the big chunk of it. And if we put an exit order in here, it'll execute the trade for us. In fact, the trade that we're going to be looking at here in a little bit, that's exactly what happened. We got into it last week, and by this morning, we were out of the trade. I didn't have to try to catch it because we put in the exit order when we submitted the trade. So we're going to go ahead and do that. I'm going to put this in my bear short verticals bucket of where we keep track of our bearish short verticals. Okay. We're going to expect that to fill momentarily. It looks like maybe the credits changed a little bit here. If I need to go back and change it so we get filled, I'll do that. But we're going to move on at the moment. Now, it looks like maybe Brent has put some nice information out there in terms of a link. Thank you for doing that, Brent. I should mention at the very beginning of our class, I posted in a link to our playlist. Okay, playlist for short verticals. So you can go back and look at some of the previous classes. They don't necessarily build on each other. Each one is a fresh lesson, but we'll emphasize different things in what I did last week and the week before is different than what we're really doing today. Okay, so that can be really helpful if you're trying to become master of this strategy to go back and watch those. Now, I know a lot of you have done this. You've become subscribers to our channel, which is fantastic. You want to do that, okay? There's a little button in the bottom right-hand corner of your screen. And if you select on that, that'll subscribe you to our Trader Talks network. Only click it once. If you click it a second time, it'll unsubscribe. Okay, so just once and you're good for the rest of your life. All right, I imagine the rest of your life. But when you subscribe, it makes it really easy for you to find our content because you subscribe to our Trader Talks channel. You can search for that if you want it as well. We have playlists to our different classes. So to find the classes that we did previously, I've gone down. This is about the 7th row down. And here is our short verticals list. And the video it's talking about and highlighting there is time decay in action with a 0 days options expiration spread. We talked about that over the last couple of weeks and what those are because you're going to hear a lot of buzz about them, and you probably have heard a lot of buzz about them. And that's how you can go back and find those classes. Okay, so subscribing is a fantastic thing to do. Now, it looks like we have in the chat a survey. Now, we don't always have surveys. We do from time to time kind of take the pulse of the class and ask you 2 easy peasy questions. And all you have to do is click in the radio button on a scale of 1 to 10. 1 is, I hated this. 10 is, I love this. I want to keep coming back. Okay, that's all you have to do. Now, there are 2 questions you can answer if you want. And I like to encourage you to, if there's something you want me to address in our next class or topics that maybe you're having a problem with, use that as space to communicate that to me because I'll be receiving the results. It's totally anonymous, but I'll be able to see what your question is. And I like to weave those into our discussions, answering your questions in the coming weeks. Okay, so go ahead and use it for that purpose. Now, if you just click on it now, that's fine. It can sit out in the background, and then when our class is over or it's time for you to leave, then go ahead and fill out the survey then. We totally appreciate it when you take the time to do that. A particular link isn't working. I'm going to let Brent work with you in the chat and identify what link isn't working. All right. Next up, let's take a look at another one. Okay, we looked at Vistra here. We are now going to look at another stock that has a different type of entry signal here today. This is him and hers healthcare. It's a stock that really has raced up the charts really quickly here. You can see in a short period of time, it's gone from, about a $17 stock, ran up to 72. Now it's pulling back. And sometimes stocks that run up really harsh, really pointedly and quickly, sometimes the harder they run, the harder they fall back. Okay. So what we're seeing here is the short-term trend bearish. This intermediate trend, that 30-day, hasn't quite rolled over that, but you can see this major pullback. And it looks like today that it's breaking through this support area of about 37. So it would qualify for a bearish entry of breaking support. And if it breaks support with lots of extra volume, that's even better. Okay. Now down here, you can see my volume. It's not quite up to average yet, but we still have some time left in the market. My expectation is by the time the market is closed, the volume here will be at least up to average. Okay, that's my suspicion, but nonetheless, it's having great, decent volume today for that selling off, especially knowing that the volume trend and that average went up quite a bit with these really high volume days. All right, let's see what we have here in terms of possibilities. So we've got a stock that's bearish. We have a stock here. It's traded 22 million in volume already. Fantastic. We love that kind of volume. That leads us to the idea that maybe the options are more liquid. Again, in the weeklies, there's not ones that were super appealing with a lot of open interest. So we're just going to go out to our April 17s. They have 42 days worth of time. Fantastic. It's within that little window we like to look for. So we're going to use our delta again. We're going to decide what strike price. And there are several here for us to choose from. We have several here in the 30s. We've got a 29. We've got a 41. And one that looked like it might be reasonable to use on this one is maybe, let's see, I had pegged the 42 and the 44 to be our spread. So our 42 right now has about a 36 delta, so kind of in the middle of that range. There's decent activity here. If you're somebody that trades a lot of contracts at a time, it might not be enough open interest for you. We don't want to be more than 2 to 5% of the open interest. So if you're working with, say, 2 contracts, 2% would be on 100 would be kind of the limit, right? You wouldn't want to maybe do more than 2. But we've got quite a bit in here for our needs for the liquidity in our account and for the risk tolerance that we have, okay? And so we can see, yeah, 99 contracts just today and 317 at the beginning of the morning. So let's go ahead. Let's put this together. So I'm going to start on 42. Right mouse click, sell, stay in the sell column, vertical, and it'll grab the next strike price right next to it. We're going to spread ours out a little bit here, okay? We may actually need to adjust this a little bit. I am going to adjust it. We're going to go 41, 43, okay? I would like to see a little bit healthier premium in here. Actually, that's a better premium. That's more of what I was expecting to come up initially. So I'm going to hit the lock. See if we can't lock in something like that. So we could do a $1 wide spread. If you're somebody that maybe has a smaller account and you can do onesies and twosies at a time, that could be really helpful for that purpose. If you want to spread it out a little bit more, like I was saying, we were going to go 42, 44. Let's see what kind of a credit we get there, about 45 cents. So our max theoretical gain on a set of contracts here, and this doesn't include any calculation for commissions, which we know there always are, would bring in about $45 per set of contracts. And we would be risking what? 2, the difference in the spread minus 45. So basically we're risking about $1.55 to make 45. Now I'm going to run the calculation on that. Let's see what kind of a return that means for us to see it's acceptable. So we're going to take 45 cents, divide that by 155. That says about 29%. So for our purposes today, that's fantastic. We would love that. Okay. So we're going to go ahead with the trade. If it doesn't meet your criteria, maybe you say, I always want to see with 42 days out, maybe you always want to see 35 or 40%. your criteria may be a little bit different. So you might adjust your strike prices so that you can bring in a little bit healthier premium than that, because we're trying to balance high probability with return that's acceptable to us. What's our probability in this trade? Now, this one right now is starting at about 76%. 76% of it expiring out of the money. Again, we want to see that the stock keeps its distance, right? Below 42. Right now, it's at what, 34? It's got a lot of leeway there, okay? Where is that? 42. Let's see here. Mouse, pretty close to where my mouse is, where you can see that pin, that's about 42. So we would love for the stock to stay below there. Maybe I'll just put my little line in there. I do like to mark my charts up. Oh, look at that, exactly. And it can go sideways. It can drop down, which gives us hopefully the probability of being able to pick up that spread, lock in our gains on it early and move on with the trade. Or it could even go the opposite direction. Okay. Now, if it goes the opposite direction too much, that's when we get into an unprofitable trade, and we would take steps to manage that. But many times, if you start out with a good leeway, it's not going to take that much. You have a lot of slack, right, in order for it to go up to where your short leg is. Okay, so this one, we've got quite a bit of room, which is wonderful. We love to see that. Okay, same thing here. We're going to do, this case, we're going to do 4 contracts. We're going to do a first trigger sequential. We're going to do this a little bit more quickly than we did before. We're going to say create opposite order. And let's go see if we get 45 cents. What if we get, let's use our same percentage that we did earlier, 75%. We get 75% of 45 cents. That means 25% is left. So we're going to multiply that by 25 cents. And that says 11 cents. So we're going to go buy this back at 11 cents. Let's do that. We're going to make it good till canceled. And we're going to go ahead. We're going to send this in. Again, we're going to put it in our group of charts that is for our bearish short verticals. And we'll be taking a look at these trades and how they fare and how you manage them in the coming weeks. Now, I mentioned to you that we would take a look and talk about managing some trades we already put in, okay? First trade that we're going to take a look at, this is going to be fairly quick, is, let's go with DECK, D-E-C-K. Of course, we just got into this trade last week, all right? I'm going to kind of zoom in. It was a nice upward trending stock. Difficulty at their earnings announcement, disappointed apparently, right? Last week we were seeing our bear flag, and then the consolidation, and then boom, the breakout of the bear flag. We got into the trade. What has it done since then? Well, it's kind of drifted down. Didn't really take a hard move down, but we put out in our exit order, we put in the ability to go buy the trade back so that it would go and grab it for us, okay? And so I had put in Decker here. What we said is we said, if we can get a good chunk of it, of our credit of 89 cents, we put in an order to say, hey, go buy it back at 27 cents. This morning, the stock was down pretty early. Guess what? We were able to lock in our gains there for cheaper than 27 cents. We got filled at 12 cents, okay? And that's something that can happen to you if you allow Thinkorswim to kind of put in some exit orders there so it can go and capture that for you, and you're not like sitting there staring at your computer all day to see what happened. Okay, so that was that particular trade. Wasn't like a home run type of trade. We had what, 5 contracts here, and the net on that, on those 5 contracts, was about 77 cents. And so it gave us, not counting commissions or anything of that nature, about a 385 gain. Okay, so nice little what we might call a base hit for a smaller trade. Gilead, we're just going to let Gilead work. Let me just show you the chart here. It's doing its thing. We're actually bullish on this stock, and this thing doesn't know that a lot of the market's in pullback territory. Okay, same thing. We got in on a bullish flag. It ran up for us just like we wanted it to. It's going sideways. It's above our 110. We are happy campers. We're going to let it work. Has 15 days to continue in the trade. The last one up here is one we did a significant adjustment for. Okay. The trade was BROS, and we did a short put vertical on it. But during the week, I had to make a change on this trade. I had to basically alter the trade. We hope to not have to do that a whole lot, but in this case, we needed to. Same thing, it's a bearish stock. Oh, that's Decker, the right one here. We needed BROS. Get back to the chart. BROS. Okay. We had seen a big gap up. They had good earnings, and we got in on this day when it looked like it was bouncing off that support level. Well, it disappointed. It broke down. It broke down to below support. There was a big gap down. The whole market was selling off. And so what we did is we went back and bought back the short put, and we're holding on to the long put. We're hoping the long put moves enough to make up the difference for the big negative that we had to buy back that short put at. The math on that short put, we had to buy it back. Our credit initially was $1.85, and we had to go buy that short leg back for $4.85. No, I take it back, for $6.70. And so the net of the $6.70 we paid, less the credit that we received initially, $1.85, means that we're down on that trade about $4.85. So we are expecting that this thing is just going to keep dropping for us, okay, to make up that difference. So right now we're down, what did I tell you, $4.85. Right now, that's kind of what we need the price of this option to be worth to get to our break-even point. It's at $5.85, so it's actually, we're starting to be on the positive side of that trade now, but we're switching rules. Okay, we're going to be using our long put rules for this one because we had to change the trade due to broken support. Okay, so kind of some different ways that you manage trades. Some of them, just give them the time they need, like Gilead is. Some of them, you have to make an adjustment to the trade like we did with Brothers. And then the other one, we have our order in there. Man, it executed for us early this morning. We're happy about that. Now, to just review the trades that we put in, I'm going to go to our working orders here. Our first one was on Vistra, and it looks like we got filled on Vistra down here. We put in HIMS, which I'm going to have to go change that, make sure we get filled on it. Oh, unless we did. No, not yet. So I'm going to have to take a look at those and maybe massage the numbers a little bit so that we get filled on HIMS and Vistra. Well, Vistra did get filled. All right, you guys, I hope this was helpful for you today. I hope you can see, man, this is a strategy that could be very appealing to many of you, right? Just depending on what you're trying to do. Now, let me get our closing slide here. Looks like maybe it, oh, good, we just got filled on our HIMS. All right. Well, we went through our strategy today. We looked at several examples. And the thing that I would say maybe what you could do is practice this strategy in your paper money. Practice it more than a few times. Like, don't throw it out there twice and think you're an expert. Put out several of them so you can go through the process of managing that trade and how it might be different from trade to trade. Now, some of you might choose to do these trades that we did here today as examples. And then you will maybe be thinking about them during the week as you watch them. And you may have specific questions. Bring those back to class next week. We'll talk through them. Well, you guys have been fantastic. Again, there's a survey out there. If you'll fill that out for us as coaches, we really appreciate when you take the time to do that. And it's easy and short, which I'm a fan of short surveys. Okay. In addition, follow Brent and I on X and make sure you've subscribed so you can find our content so much more easily. I love that feature about YouTube because I subscribe to a lot of different podcasts and YouTube stations. Brent, thank you for your help. out there today answering our questions. Thank you to every one of you being here today. Join me next week as we follow up on these trades that we put in here today, as well as some others. We'll look forward to seeing you next week, same time. Have a good afternoon. Coming up next is Getting Started with Stock Investing with Mike Fairborn. That'll be a great class. Bye-bye.